Let's take a deeper dive on the broader markets as earnings season picks up steam. We've got Manulife Investment Management Global Macro Strategist Eric Theoret joining us here on set. Eric, great to have you here with us today.
Thank you.
Absolutely. Okay, so we just ran through some of the earnings, but I think what's noteworthy within the entire situation we find ourselves in right now is that CEOs are signaling this is kind of a time that's unlike any before. However, they're still trying to get ahead of the markets to the best ability possible at this point and signal what's impacting their business. What do you kind of take away from that and what the economic impact could be as well?
Absolutely. I think we're in a period now where we've seen a tremendous amount of tightening from central banks around the world, really trying to moderate the pace of economic growth to bring it back into line with capacity. And so we've obviously got inflationary pressures that we're still dealing with. I think the sign that basically we're still operating above capacity in a hot economy. And so I think the slowdown that we're starting to see is needed, but that does pose a challenge for companies as well. So if they start to see top line revenue declines, what does that mean for their margins if their costs remain elevated?
Also, wanted to point out employment and jobs because we heard Alexander talking about Goldman and the cuts there. We also have seen cuts when it comes to the tech sector. The labor market, though, is still relatively tight. I mean, it's slowing down, but it's still tight. We had a survey out this morning talking about 60% of CEOs surveyed that they are reluctant to lay off workers. So what does this mean for the overall picture? Could we see a slowdown, a recession with a labor market that is still relatively tight? I mean, is this different than other recessions or slowdowns?
Well, I think that's a great question because I think coming out of the crisis or the great financial crisis 10 years ago, we had the concept of a jobless recovery, right? And so in this case, I think the question that you're posing is whether we can have a recession without the loss of employment. And again, as we see in the data, the unemployment rate is low. We continue to add jobs in terms of headline jobs numbers. And what we've seen in terms of reductions are really more high profile, big name reductions rather than kind of sizable quantities. And so I think that's the key piece is the extent to which the overall labor market really is starting to see some challenges. And we're just not seeing it play out in the data just yet.
With some of the warning signs that CEOs are talking about and kind of ripping the Band-Aid off of what those expectations could be and how much it could impact them, what would you be looking at in terms of your investment portfolio thesis right now? And would it be more bullish given that everyone is just kind of putting the bad news out there at this point?
Yeah, I mean, I think, again, as we see the data develop, the high-frequency activity indicators are still hinting towards economic contraction. So PMI is sub 50. Those are economic headwinds that we're still heading into and that are still actually strengthening given the tightening that we've seen from central banks. So as you look to kind of constructing a portfolio, you want to be defensive. So in the defensive sectors, healthcare, staples, utilities, those have seen a tremendous outperformance over the past year or so. The broader markets are still, I think looking at the charts from a technical perspective, still in a downtrend. And so at this point, you still want to be defensive in higher quality on the fixed income side in terms of credit. And again, in terms of sectors and looking more globally, just taking less risk overall.
What about the FX market? Because we have seen the dollar come down a bit. I mean, at one point it was really having an impact on equities. So what do you make of that? And also commodities as well?
Yeah, so I think, one of the key pieces driving the markets, again, has been this central bank tightening. And to the extent to which, the Fed really was at the forefront relative to its developed economy peers in driving that tightening and delivering U.S. dollar strength. So as the Fed gets closer to its kind of end point, we have seen a pretty material decline in the U.S. dollar. And I think as we see, almost the kind of good news or bad news is good news dynamic play out, we could see continued weakness in the U.S. dollar, again, as the Fed starts to look at these growth headwinds and gets a little less concerned about inflation.
Thank you so much, Eric Theoret, Manulife Investment Management Global Macro Strategist.